Ladies and gentlemen, good afternoon and welcome to the third edition of the Finance Evolution Forum, hosted by Lexify. I'm Sara Di Capua, Legal and Compliance Counsel at Lexify. It's my pleasure to host the event for this edition. It's a real pleasure to see such a full audience today on such a beautiful day. We all know that the financial sector is evolving faster than ever, driven by innovation and new technologies. So today, we will explore together some of the most important current topics in the financial sector, from the tokenization of the financial instruments, bridging banking and blockchain, the role of the artificial intelligence in finance, and the CARF framework. But that is not all. We are also proud to host a high-level panel dedicated to a delicate balance between regulation and innovation in the digital asset ecosystem, bringing together leading voice from the worlds of supervision, academia, and public institutions. Before we begin, I would like to extend a sincere thank you to our sponsor for believing in this event. Ephelia Capital, 21 Shares, Cube Finance, and Rutto Crypto Trading. I wish you all a great session, and now I will give you the floor to our first speaker, my colleague Alberto Borri, who will speak on the tokenization of the financial instruments. Thank you.
Thank you, Sarah. Thank you for the nice introduction. So this is our agenda today. So welcome again also from my side. Always very happy to see so many people to our annual flagship event here in our wonderful Lugano. I will start today with you discussing about a topic that is pretty present in the markets nowadays. We are receiving a lot of requests regarding the tokenization of assets, but also about the tokenization of financial instruments. And we follow, since last year, one of the main tokenizer of financial instruments at a global level. And I will bring to you also a real use case today. So we'll just discuss about the regulation, but I will bring to you some example. First of all, every time I discuss with clients, partners, and so on, I see that the people mention about tokens or crypto asset generally. But from a legal perspective, token does not mean anything. Okay? Every time you discuss about token, you need to do a specific assessment of what is that token. And the first rule that you need to follow is to assess if that token is a financial instrument or not. And that's not something so easy sometimes. But no worries, that's our job as lawyers, okay? In case a token is going to be classified as a financial instrument, the crypto regulation does not apply, let's say, the Swiss crypto framework or the European MiCA framework. Today I will not just discuss about the Swiss setup, but I will also bring to you some comparison with the European regulation, because nowadays it's important also to see how the cross-border matters are involved in this project. So for example, I see people discussing about tokens that are financial instruments and they mention MiCA, for example. That's completely wrong, because MiCA does not apply to tokens that are financial instruments. So if the token classifies a financial instrument, I'm sure that you know what is a financial instrument. So shares, bonds, stocks, derivatives, structured products. The traditional financial regulation should apply. In all the other cases, if the token is not a financial instrument, then the crypto regulation will apply. This is the first thing very important to assess. In Switzerland, since 2021, we had the adjustment of the traditional regulation to the development of the DLT technology. So Switzerland has been one of the first countries in the world since many years ago with the first crypto guidelines from FINMA and so on to adjust the regulation to these new developments. So we had the introduction of Article 973 of the Swiss Code of Obligation that introduced the definition of tokenized financial instruments. Then we had also some adjustment of the market infrastructure law and the AML and the other regulations. In Europe, what happened? Europe always, it's a little bit slower comparing other jurisdiction. As you see here, you can see MiFID II. MiFID II is not a regulation that you are used to see in the crypto space, but if the token is a financial instrument, MiFID II should apply. Then we have the prospectus regulation, that it's similar to the regulation and the requirements that we have here in Switzerland. And the prospectus regulation, it's very important if you want to offer tokenized financial instruments to retail investors. And then we have the DLT pilot regime, that has been the last framework that the European Union issued, which goal was to update the current framework, introducing some kind of definition and taxonomy. I make you an example. If we have a financial instrument in the law defined in a certain way, it's not something so easy to issue the same instrument with the blockchain technologies, because the law requires you some kind of specifics that the new technologies does not have. So there are some inconsistencies. And the DLT pilot regime has been issued for these purposes. So if I want to issue a tokenized financial instrument, what I have to do? The first regulation and the most complex one that you need to follow to offer to the public is the prospectus regulation. So you need to draft a prospectus. The prospectus is mandatory if you want to offer your token to retail investors. But we have some exemptions. So if you offer the token just to qualify investors, we don't need to do a prospectus. If we offer the token just to 500 people in Switzerland or 150 people per member state in the European Union, if the ticket size of the token is at least 100,000 Swiss francs in Switzerland or 100,000 euro in the European Union, or this is the last one, is the exemption that usually is used most by the issuer that begin to issue this kind of products, is the threshold of 8 million Swiss francs in Switzerland or 12 million Swiss francs in the European Union with the new regulation, that is the Listing Act, that increase a little bit this threshold. So if you follow in one of these exemptions, we don't need to do a prospectus, okay? But in case you want to offer a tokenized tracker certificate, that later we will see that what we have done, to retail investors without any cap, we need to do a prospectus. So we need to prepare a base prospectus, and these documents are the one that I'm sure all of you that works in the financial markets read every time before subscription. I'm joking, of course. It's 220 pages documents that as lawyers we manage. Then you need to do final terms that are the documents related to each specific tokens. And then you have the KID, the key information document. These are documentation I'm sure you know and you're used to when you work with investment funds and financial instruments. What I'm just telling you now apply also to shares and bonds. Of course, these are financial instruments. So if you want to tokenize a shares, the token will represent a share of your company. So you need to amend the article of association of the company, manage the UBO register, because when you transfer the token, you are transferring shares of your company. You can do the same with bonds, but usually when you need to issue a bond tokenized, you need to manage the regulatory setup and the legal setup of that instrument. So the term and condition of the bonds, the type of yields, and that kind of specifics. I mentioned to you before that it's not so easy sometimes to assess if a token is a financial instrument or not. As lawyer, we are discussing a lot on these topics since a couple of years now. Not in every jurisdiction a financial instrument is defined in the same way, and there are many complexity. On this point, the European Security Market Authority issued some specific criteria in order to interpret if a token is a financial instrument or not. And the three one that I want to bring you today is that, first of all, we need to be sure that the token is not used as an instrument of payment, because otherwise will fall under other regulation, belong to a class of securities, and is negotiable on the capital markets. And this last criteria, when we discuss about tokenized assets, we have it, because it's inside the technologies that we are discussing nowadays, and so the token can be transferred, sold, and be marketed on different venues. What we have done with the project that I mentioned early before, we issue a tokenized tracker certificates. So I'm hearing a lot on the market, the willing to tokenize financial stocks, all the main financial instruments that are listed on the stock exchange. Let's say Apple stocks, Tesla, but we cannot tokenize that stocks directly because the issuer didn't issue that shares on a DLT. So what we have done, we create a tracker certificates that represents the value of the underlying. You know the trackers are certificates, so are part of the structured products, and we were able to issue this kind of token, have the base prospectus approved in Liechtenstein with the FMA. We prepare all the final terms and the KID. I'm sure you are wondering why we choose Liechtenstein and why we choose FMA, probably, and why you didn't go in Zurich or in London, Paris, somewhere else. We choose FMA because it's been is in the economic European area. Okay, so we have access to the European market. So the base prospectus that we drafted with the final terms and the KID, they have been drafted according to the European prospectus regulation, but we can passport that prospectus also in Switzerland. So without needing to have any other approval, having this one approved by FMA has been possible to offer also this product to retail investors in Switzerland. Last but not least, remember always that these tokens cannot be listed on all the crypto exchanges. Many people came to me and say, oh, I want to tokenize the shares of my company, and then I want to list on Binance and I want to raise billions. Say, okay, wait 1 second, because Binance is not an authorized trading venue for the listing and for the exchange of financial instruments. All the crypto exchanges that you know, the biggest one, they have a lot of liquidity, they cannot list financial instruments. Then it's another discussion if some other exchanges around the world, there are some tokens that are financial instruments, but they cannot do that. So this kind of token can be listed just on authorized trading venues. And in Switzerland, we have BX Digital, AG, they can do that. SIX, you remember about SDX, that now does not exist anymore, but the SIX group is working. They have some kind of solution. And we have also some of these venues in the European Union. So 21X AG, we have Bourse of Stuttgart, they are working quite a lot to expand this kind of trading venues. And we have also, for example, Deutsche Börse with D7 that are working on that. So to sum up, always remind that the first thing to do is to really classify in the right way what you are doing. Then remind that if the token is a financial instrument, the same rules apply as it is a traditional one. And the blockchain technology sits on top. Okay? So the fact that you issue structured products, tokenize it doesn't mean that you don't need to do a prospectus, a KID, or you need to follow the investment service regulation that apply to financial instruments. So this was my speech. I hope to don't have bother you too much with technicalities. If you want to deep dive on these topics later, when we will have the apero, we can discuss together. I will leave now the floor to Franco Mignemi for his presentation. Thank you.
Thank you very much, everyone. Thank you, Alberto, for stealing 8 of my minutes. And let's start with our presentation. So, converging parallels. We start with an oxymoron. Can we converge parallels? Well, at least we can try to create bridges. We are talking today about AI, artificial intelligence. We are talking about banking. We are talking about blockchain. Obviously, the solution that we're going to discuss today are not related only to the financial services, are related to all the world of corporates and businesses, and of course, individuals that are going to use the services that we are trying to sell. Let's start with the logic, why we said converging parallels. What we see as a failure, today reality is still disconnected and very slow. Why? Because when we talk with banks, when we talk with the regulated entities, when we talk with corporates, we still see piling layers on top, on top, on top. We have discussed with a UK bank just a few months ago, and we have seen 3 core bankings, one on top of the other, serving the customers. From my point of view, in terms of risk, this is quite dangerous. Opportunity offered by the blockchain and AI are still seen like, maybe we don't know, we don't want to talk about confusion about what still today, what crypto and blockchain is. So where the problems sit, difficult. Lack of knowledge, for sure. Many tech CTOs, they know or they pretend to know, but not really know what we are talking about. Fear of change, for sure. Change is a problem for everyone. Lack of budget, small one sometimes. Or is a genuine risk? The answer is in between. There is no real answer. Definitely we have 3 points here that we are mentioning. Blockchain has been created to address a specific need. When the Bitcoin at the beginning and the blockchain started, there were a need. So there were a public for that. Obviously, financial infrastructure must rise this challenge, must have to explore what the real blockchain is. AI offer an opportunity. We are in a moment where the paradigm can shift again. AI is changing pretty much everything. We have to see where we are. Obviously, when we talk about corporate, there can be a little bit financial institutions have to be a little bit careful in order to use the system. We're going to see later anyway that the way that we interpret in artificial intelligence is always human in the loop. Both technology, both financial institution and corporate. And the last point is obviously the main one. People need change. So financial infrastructure must be flexible and try to adapt. But let's start again with the numbers, because sometimes the number, they say something and then they say the opposite. When we talk about cryptocurrency as a minimum payment, we are still talking about less than 1.5%. So there is a real need. Let's see later. Cryptocurrency are used as an investment by 6-7% of the population of the world. Volume, asset under management, we are talking about 1-2% of the total value of financial assets. So it's real a problem. Different is the AI. We see now that the AI has been the penetration in the financial services. We are already at 70-80% of penetration. Obviously, at the moment, this focus mainly of the big institution that they are exploring what the AI is doing. But remember what we said before. We have in a moment that the paradigm is shifting. So even smaller institution, even smaller corporate, now they have a very narrow gap between big institution thanks to the AI, conceptually. So this is why I said we have to be careful, because it's true that the AI adoption has increased by 25-40% over the past 2 years, but the answer lies in the infrastructure. So AI should be embedded in the infrastructure. Otherwise, AI is a Google++ that many companies are using, burning tokens and spending money. This is what's important. Cryptocurrencies as an asset under management, we said a few points percentage, but the rate exceeding 90% as an annual growth. So what we are seeing is something that exponentially is growing year by year. And finally, cryptocurrency, better, stable coins as a mean of payment. We believe that they're going to remain small in terms of volume, but stable coins that are becoming electronic money tokens, this is the answer. Already institutions, they are discovering that the e-money tokens are the answer in order to make payments, in order to maintain the regulation proper, just tokenizing what the electronic money is as of today. And finally, this is what we are trying to do with Ophelia. We said human in the loop because AI first infrastructure design should remain human in the loop. So the company are changing. employees are becoming supervisor, employees are becoming managers, and AI should do the work. Core banking for payment and investment powered by blockchain. So we are not talking about cryptocurrency here. We are not talking about any specific token. We are talking about technology, blockchain. So as of today, if I tell you how I move the money, you are not very interested how SWIFT has been built up or SEPA, which are the database, which are the infrastructure. So this is why we wrote this very small, because blockchain is just technology. It's not something that we have to be worried about. Tokenize e-money and security, as we said, this is the answer for us, because they are programmable and potentially they're streamable. So we can create, as of today, new product, where new verticals, where the economy and securities and payments can change the way that they serve the people. Obviously, compliance first architecture, so we have to maintain the compliance focus. As a failure, we have launched in the month of March what we call Failure Labs. So we started to discuss with builders. We call them builders. So builders are young people at the university, teams that want to build something on this infrastructure. So we help them offering our infrastructure to develop new products and new verticals. And tester. We are working already with few financial institutions at the moment between UK and Italy. They are starting now to test our artificial intelligence layer. They are starting to test what streamable and programmable e-money token are. And hopefully we should achieve what we want. After the speech, if you want to join us at our desk, we can give you something to test. So for AI, at the moment, we are just starting with what we call customer service plus for corporates and financial institutions. We are talking about an agentic platform. You can start to test and try. Obviously, this is an alpha, so I suggest not put crucial data or something there. But you're gonna start to see how different is the classic LLM, so the ChatGPT or whatever, from what an agentic system is. Thank you very much.
So thank you, Franco, for your presentation. And now we will start, we will anticipate the panel. So I invite our guests to come on scene. So first of all, Mr. Edoardo Beretta, which is professor of economics at USI in Lugano. Then we have the great pleasure to have with us Matthias Obrecht, head of market analysis at FINMA, who did a long trip from Bern to come here in Lugano under heavy rain. And we have also Pietro Poretti, director of economic development of the city of Lugano. So you have the mic, one is each. So what we want to discuss here today in the panel is a little bit how is finance evolving, how is technology evolving? And my first question is for Professor Beretta. Can you give us an idea, a presentation, what will be the payment system of the future? We heard speaking about stablecoin. What will be the impact that we can have from stablecoin, also from an economic perspective? And since I know that you have also prepared some slides, I hand you this gadget here.
So thank you very much for the invitation. It's a pleasure to be here. And yes, indeed, these are extremely relevant topics because we are experiencing a great evolution in terms of payment methods. So back in the past, we had, maybe I can go through the slides related to this. Let me see. Okay. So this is just to say that in the past we had a trend towards dematerialization. So the shrinking physicality of payment methods. This was the main trend over 100 years. Think of gold, then certificates on gold, so e-cash and so on. So credit cards, debit cards, even before. This was the trend. Now we have a parallel trend to the materialization, which is digitization. So digitization is pushing this trend even further. And we can see this. I have picked some data, random data, because I'm sure that you know many of these data even more than me. But in general, these are Swiss National Bank's data concerning Switzerland. They have been collected through service among consumers. And you see how over time the share of payment methods in remote transactions, so that's the right panel, and in physical transactions, so offline, that's the left panel, have evolved. So cash was the leading payment method still in 2017. It's not that far, and has been surpassed by the debit card. While other incumbing payment methods, like not necessarily the credit card, but mobile payment apps, are really pushing this twofold trend. So dematerialization plus digitization. So I think it's very reasonable to ask whether which type of payment methods we will hold in our pockets. Just going through to the second slide I had for this question, and concerning stable coins. What are stable coins? Well, very briefly, they are private digital currencies. So they are a tool which is, I'm simplifying, they are a tool which is anchored to fiat currency, mostly with a one-to-one peg. And they are based on blockchain. And they are issued by private companies in general. So this is an interesting graph, I think, because it's very recent and it shows how fast stable coins are converted into a fiat currency depending on the region of the world. That's relevant because it gives useful insights into the way stable coins, so potential future ways of paying, even more than today, are used. So you see that, for instance, in North America and Europe, there is a low conversion rate, which means that they are mostly kept as a store of value. While in other countries, they are useful also to get access to funds, to have a more distributed and capillary way of getting access to these funds. So I think that this will be one of the main challenges for advanced economies. So how do we want to see in the next future stablecoins? Just a store of values, or also increasingly as means of payments? Trust, reputation, will be for sure one of the keys, one of the main drivers in this process.
So speaking of trust and reputation, we have here one player, Mr. Poretti, which is the city of Lugano, which issued a stable coin with the Luga, and I think the city has the trust and the reputation that is requested by the market. What can you tell us about your experience with your own stable coin? So a municipality issuing a stable coin is something, I would say, very unusual, and I suppose you're the only one still in Switzerland doing so. So what are the lessons learned, and what are the, what can you tell you about this program that you have?
Yes, it is, Lars, you know, it's a payment token. We call it payment token, Luga, the payment token. I feel like I will be preaching to the choir, though, as they say in English, right? Because there are people in this room who know our initiatives better than I do, to some extent at least. So let me take one step back and tell you why the municipality has engaged in this field, which some may find surprising. And everything started in 2019, I would say, when the municipality identified, say, blockchain technology or crypto as a strategic field, as a field where we should invest, also in terms of economic promotion or with an objective of economic promotion. This didn't happen, of course, by hazard, let's say, or as a coincidence. It did happen because at that moment, the discussion on the Swiss DLT Act was taking place, so 18, 19 particularly, and also the realization that Lugano is an important financial hub. Although at that moment, at least, it was probably losing a little bit of steam, if I may say so. So based on those two, on that context, we thought, let's see what we can do to try to promote this sector and turn it into one of the strengths of our region. And the next question was, how can a municipality, how can the public sector help? And of course, Lugano municipality is not a state, so it cannot regulate. In Switzerland, it's in principle Bern, the parliament, or the government, and the financial regulator, of course, would do that. What can be our role? The pandemic helped us, and we defined that moment, which was, of course, a very negative and to some extent also sad moment for many of us, as the trigger. Because the Luga was conceptualized and introduced as a tool, an instrument to support local small businesses. It is a token, a payment token, as I mentioned, that comes with an app and that allows people to purchase and pay and receive a cashback. So the incentive is the cashback. Now, in a few words, our experience has been overwhelming positive, I would say. It has been positive even for us as municipality. We believe it has been positive for those who have been using this instrument. And it's also, and I end, it is also the initiative that then opened the gates, let's say, to other initiatives that I will be happy to maybe illustrate later.
Exactly. So, Mr. Obrecht, now the big question for you. We have heard stablecoins are coming. We have seen the city is already using them or trying to make some experience with them. So, from your privileged position at the financial regulator, what can you tell us? What do you see? And how can FINMA encourage this movement, or what are even the advice that you will give if someone wants to start such a new, issuing a new stable coin or doing a new business with this technology? And since I know that you have also provided some slides, they're there, so you can just move it with a remote control.
Yes, thanks a lot. First, thank you for the invitation. It's great to be in Lugano, a very nice place. Unfortunately, I will have to leave again tonight, but I think your question is very relevant, and you touch upon innovation and upon stable coins, both very important topics also for FINMA, of course. So maybe to go first into the more general topic of innovation and what is actually FINMA's responsibility. FINMA is mainly a supervisory authority, so we apply the law that is given to us from Parliament. We are not really a regulator that makes its own law, but sometimes we support our Parliament and our federal administration in making new laws, and stablecoins is actually one example. But FINMA's primary mandate and primary objectives is the security of the investors, security of customers, security of depositors. So we have the banking regulation that protects depositors and the investor protection regulation, as we already heard some important examples. And a Swiss regulation is technology neutral and principle based. This allows us to apply the existing regulation already to new technologies and new business cases, which gives us an advantage and gave us an advantage in the past to react quite swiftly to, for example, the developments in the space of DLT and blockchain. The FINMA ICO guidelines and stablecoin guidelines had already been mentioned by previous speakers, and such things are not possible maybe in very prescriptive regulations. For example, the EU regulation is much more detailed, and of course then you have less space to interpret regulation. So we try, as FINMA, we try to give clear guidelines, clarity, legal clarity, the rules of the road, if you will. And by providing this clarity and in a technology neutral way, we try to provide an environment where innovation can grow, right? It's not our role to pick the winners. It's not our role to say this technology is better than the other technology. That's up to the market to decide. But our role is to create a level playing field and remove obstacles that are not justified. So when it comes to stable coins, as of now, we are still in this technology neutral, same risk, same rules environment. We don't have a specific stablecoin regulation in Switzerland compared to other jurisdictions. We are quite slow, actually. For example, MiCA is in force for more than 1 year, and it had been created a long time ago. The US is now pressing ahead with the Genius Act, and Switzerland is somehow following. But this doesn't mean that stablecoins are not regulated in Switzerland on this technology neutral basis. Stablecoins are basically regulated as deposits. So a stablecoin issuer, unless some exceptions apply, is regulated as a bank. And of course, you can argue if the banking regulation is really the right framework for a stablecoin issuer. Maybe not, right? And that's the reason for the ongoing regulatory project. Here, the Department of Finance is in the lead. It will go into Parliament, I guess, next year. I don't have final information on that, and we are supporting our Ministry of Finance with technical advice in order to address the risks, but also create a product that is useful in the end for market participants.
Thank you. Mr. Poretti, again, but does it work? We have seen there are stable coins. You told us we are doing it. We heard, yes, FINMA is looking at this, same business, same rules. But what is the experience of the city? I mean, now it's what, I think 4 years, 5 years, and you say 20, no? 2020, it's almost 5 years that you have issued the Luca. You have also issued a bond, you tokenize a bond for the city. So what is your experience? Is this working? Yes, we heard in the slide before, there is still a few numbers of percentage of people using this technology. What is your experience on that?
Well, on the working, of course, we should define working. I have no doubts that the technology that the city has to some extent developed or certainly promoted with the support of some private, third parties, private partners, works itself. It has been tested. As you mentioned, Luga has first been issued mid-December 2020, so during the first year of the pandemic, as you remember. So by now we can say that the technology certainly works. It has been tested, it has been improved and then adjusted to the extent necessary. I would probably also address the question of whether it has worked so far, if you would have to draw a line now and say, okay, 5 years into this experience as an important project for the city of Lugano, which results it has delivered. And there I would say that Certainly, the most remarkable one has been the visibility and the notoriety, also, if I may use that word, that what we have done has offered to Lugano. Lugano today is, I believe, quite solidly, I'm not overstating this, on the map when it comes to financial innovation. Certainly crypto and blockchain, but I would go beyond that. I would say financial innovation in general, which was, I would say again, not the case 5 years ago. Certainly not the case. So in that respect, mission accomplished. It has been a success. Moving now to other parameters that we could use to assess the success of our initiatives. Well, in Lugano, we have had, we counted them, over 100, I would say 120 companies that have incorporated in Lugano after, I would say, 2022, and that are active in this space. So that is certainly another measure of a certain success that results in employment, of course, in let me also say, taxes paid also to the municipality, which is an important element to us, certainly. People are talking about Lugano. We see that every day. Of course, ultimately, a business can choose a different location, a different destination within Switzerland or outside. But today, we know that many at least consider Lugano as one of the options to explore. And that, per se, is already a success, I would say. Thank you.
Mr. Obrecht, we have heard from Mr. Poretti, 120 companies that come in this, working in this space here, just in Lugano. I don't know how many there are in Zug, in Zurich, I suppose a lot. What is the experience of FINMA with this company? Is there any problem? What are the, if you could give an advice to companies that are launching their business, where they have to be careful, what they have to manage, what would be your advice?
Yeah, that's an interesting question and quite difficult to answer, of course, because it depends also very much on the business model. But maybe taking one step back, right? Of course, our main job is looking at the risks, which is maybe a little boring, but quite important when you think about creating trust, and people actually should trust in financial companies, right? So maybe first you look at the economic and political environment, and there you already see a lot of risks that apply today in general, but also to the financial market especially. But these are not fintech-specific risks, of course. But when talking about the fintech companies within the general framework and within the general risk landscape, maybe one point that we make, try to avoid unnecessary risks, right? There are some risks that you can avoid easily. And when preparing my slides, I focused a little on stablecoin business models, because we are talking about stablecoins today, and because we have very good examples of risks that come with stablecoins. We have this two sides of the coin, right? Like huge advantages that can come with stablecoins. I hope this is somehow understandable. You have this. I just try to create three buckets here that are huge advantages of stablecoins, but also risk factors of stablecoins. First of all, it's peer-to-peer transferable, same as cash and other cash-like instruments, bearer instruments. But unlike cash, it's transferable on a global scale and instantly. So if you want to transfer some millions in cash to a sanctioned country, for example, you will have some quite challenging logistical difficulties, right? If you want to do the same thing in stable coins. you're done within minutes or maybe less than minutes. And then it's anonymous. Stablecoin transactions, basically peer-to-peer and anonymous. All three of these factors are very interesting, and there are a lot of upsides to them, but there is this flip side. New risks come with that, and there are different ways, of course, to address this risk. So my message to projects would be: analyze your risks, be aware of the risks, and think how to address these risks, right? And just to illustrate some more, this is a recent report by Chainalysis. It focuses on crime-related illicit use of stablecoins. On the left-hand side, I think you see the growth rate. It's impressive. It's frightening. And in the other graph, you see the percentage of stablecoins, and also this is growing a lot, right? All the ransomware payments, sanction evasion, money laundering for drug cartels, and all these things is moving to stable coins very, very heavily. So we have definitely some risks. We must be aware of these risks. It's also important when you think about it globally, right? Maybe sanction evasion is not that big a topic in Switzerland. It's an important topic, but when you think of other jurisdictions, it's much more important, and then you have quite a difficult risk exposure to other jurisdictions that use sanctions extensively, right? And when thinking about how can we mitigate these risks. The risks will never disappear, but we have to do whatever we can to lower the risks and keep them in check. So when thinking about stablecoins, it's kind of a spectrum of risk mitigation measures. The most secure way and the most level playing field way is to say, okay, my stablecoin can only circulate among wallets that had been identified by financial intermediaries. That's more or less level playing field to the banking world, because also as a bank you cannot have anonymous transactions. And on the other side of the spectrum, of course, it's the approach, I identify some bad guys, and that I don't allow the bad guys to use my stable coins, but anybody else can use them. And there are some ways in between. As of now, as we don't have any specific stablecoin regulation in Switzerland, we are very much on the green side, on the level playing field side of the spectrum, looking ahead, looking and thinking about the future regulation. Probably there will be more gray areas and more space for projects to decide how much anonymous transactions they want to accept and which risks are they ready to take. And this leads me back to the beginning. So once we have this possibility in the law, of course, a solid risk analysis and a solid thinking process, which risks are you willing to take and how to mitigate them, will be even more important than it is today. So I hope that helped illustrate our approach.
Thank you very much. Last question for Professor Beretta. Okay, now how will the future look like? So we have discussed stablecoins are coming. We have discussed what are the risks of using stablecoins, but what is in the future? So you have shown also the global use of stablecoin is increasing. So we are expecting, I suppose, that with the years more and more people will use stablecoins. The European Central Bank is also discussing about a digital euro. The United States, they will not issue a digital dollar, but they will promote the private stablecoins. And Switzerland, we will see what Switzerland will do once the other countries have issued their own stablecoins. Can you give us, from your point of view, how will be the future of finance based on this discussion?
Well, I think that there will be for sure, and let me also show you once again a couple of slides I have prepared just for sake of immediacy. That's the landscape. So you mentioned CBDCs, so which are the main, I think, incumbing competitor of stable coins, namely digital cash issued by central banks, which could be on a retail basis, so everyone has access to it, or on a wholesale basis, so only bank actors have access to that. This is the latest data for May 2026. If we would have looked at this map just 4 years ago, 5 years ago, or a big number of countries would have not already been in the phase of exploring CBDCs. So this is one of the main, I would say also, not challenges, but also one of the main scenarios we will have to deal with potentially, besides stable coins, beside digitization. This is just a very brief example of how these CBDCs could work in practice. It's a very complex topic. There is a lot of economic literature on that. The access to that e-cash, so e-cash, as it has been said before, is nowadays an oxymoron. So once again, it seems antithetic to say that cash is digital, because cash is mostly physical. But e-cash would overcome this trade-off between physicality and digitization. And in the case of a retail CBDC, people, so non-banks, would have access also directly to the central bank. This has some risks, like digital bank runs, like AML, KYC compliance, reputation issues also. Anonymity, because on the one hand, cash is anonymous, but it has some cons in terms of potential illicit transactions. So e-cash should be anonymous, but not so anonymous to allow for systematic illicit transactions. So I have just posted some quotes, so quotation marks miss, but that's the statement of the Swiss National Bank. That's the third bullet point in terms of pros and cons of CBDCs, the central bank, the Swiss National Bank, is looking for, or it's exploring, a wholesale CBDC, while take the European Central Bank. The European Central Bank is mostly going for a retail CBDC with limited access to non-banks, so up to potentially €3,000, to avoid that commercial banks get in trouble because of people might decide to deposit their funds there. This is just very briefly the trend of the market capitalization of stable coins, how it has jumped within some years. So stable coins, private digital currencies, CBDCs, public digital currencies. So once again, we have this potential trade-off. Let's see if in the future it will be overcome. Just out of curiosity, I have checked the evolution of the active addresses by stable coins, and you see that they have also jumped. So it's not just a matter of capitalization, market capitalization, but also of users potentially. And well, some data as of a couple of days ago. What's interesting for me as a macroeconomist, it's that stable coins are issued by private subjects, but they very much resemble somehow an old-fashioned currency regime, which is called the currency board. You might know the currency board. You have a fiat currency, which is anchored to a stable currency like the dollar, one-to-one. You have then your reserves backing your issues of local currency. So it, history, I'm not saying that it repeats itself, but digitization is the new envelope, but there are still some interesting monetary common parallels with other cases.
Thank you very much, Mr. Beretta, for this forward-looking into the stablecoin. And I would like now to open the discussion also with the audience. So if there is any question to our guest, it's now or never. So first question.
Hi, my name is Roberto Gorini. I develop DLT technology. I developed the civic coin Luga of the city of Lugano. This is a payment token. And the Swiss Ledger and the other project. So I understand all the problem of the anonymity of stablecoin is a question for Mr. Obrecht. Anonymity and the crime connected to the stablecoin, but the crime is still a crime if you use cash or bank or stablecoin. I think a crime is still a crime. But here in Switzerland, we are allowed to use all kind of cryptocurrency, stablecoin tokens, and everything. So, does it make sense? The question is, does it make sense that European issuer, if they wanted to deploy issue a stablecoin in Swiss franc, is not required, the issuer, if it's European, is not required to verify all the user connected to the transaction a peer-to-peer way in the several blockchain. But if a company in Switzerland want to issue stable coin connected to the Swiss franc, is required to verify all the user in a peer-to-peer way that we know that it's basically impossible. So basically, I can deploy a stablecoin, Swiss franc stablecoin from Europe and for the Swiss market, but I cannot deploy a stablecoin in Switzerland for the Swiss market. So it sounds a little bit like a disadvantage for a Swiss company.
That's an important point that you raise, absolutely. So just to state that, it's of course possible to issue a stablecoin in Switzerland, but we don't have specific regulation for that, and so it might not be a perfect fit. That will change. But the more important topic that you raise, of course, is that not all jurisdictions have the same rules, right? We are in the middle of Europe, and the countries all around us have somehow different rules than we do, first. And second, we have a very open cross-border regime that plays into that, right? If you look at MiCA, for example, it closes the cross-border market. So even so, if we had the same regulations as in Switzerland, it would be probably not possible to issue a stable coin in Switzerland and like export it to the European Union. The vice versa, it's possible because we have a very open cross-border regime. And on top of that, we have more stringent anti-money laundering regulation than the European Union, at least in this case. It's a very specific example, but in this specific example, it's definitely not a level playing field. Switzerland has much higher requirements. So that's not nice, right? But
in the future, we'll change something in the future, maybe?
First of all, the Swiss framework will probably be more flexible in the future, because as of now, as I try to illustrate, as of now we have this level playing field approach. We should have the same standard of security as we have in bank transactions. So that's nice, that's good, but of course it can be challenging if other countries have much lower requirements. And secondly, also the European Union is moving. Of course, I'm not familiar with the details, but I know that from personal discussions with colleagues in working in other jurisdictions all around us, they are not happy with their framework. They see a lot of risks that are not addressed. So it's possible that the bar will get higher for stablecoin AML duties in the future, but that will be a political discussion in the European Union, and on the other side, we will have the political discussion in Switzerland. So in the end, the situation that we have as of today is just a result that we have different countries, and every country has its own rules that of course can lead to such frictions.
Thank you for this question, Roberto. It's very interesting, but I'm not an expert in how international banking works, but imagine if I'm in, let's say in France, collecting Swiss francs, issuing a stable coin, and then it's fine. But with these Swiss francs, I cannot keep it in France. I have to deposit in Switzerland. Is that right? You cannot keep Swiss francs outside the Switzerland system, right? Or not?
So I can try to take this question. So I wouldn't say it's impossible to be, because there are several reasons. The first question, of course, is how are the Swiss franc stablecoins backed? They can be backed by bank deposits. So maybe you find a bank in France that offers you a Swiss franc account, and then you can hold your reserve assets there, and or you can back your stable coins with government issued bonds or commercial papers denominated in Swiss francs. So if you want to issue the stablecoin in France, of course, it should be MiCA compliant, and then at least a significant part of the reserve needs to be in bank deposits. But still, that is not impossible, at least, because foreign banks are allowed to offer deposits in Swiss francs, and also the Swiss National Bank allows, in certain cases, foreign banks to have access to central bank liquidity. So the foreign bank can either go through correspondent banks or can go directly to the Swiss National Bank. It's much more complicated than when you do it in Switzerland, but I wouldn't say it's impossible.
Thank you.
Please, I ask you to tell us to whom you want to pose the question, and not only to FINMA, please.
My name is Michael Brückler. I'm the president of Swiss FinTech Alliance, representing all fintechs licensed by FINMA Article 1B banking law. My question goes to Mr. Obrecht. I'm sorry. I mean, we are here at the Evolution Finance Forum. Our biggest problem is speed, and time is money, and this is our main problem. We have this license category since January 2019, so we are now 2026. We have 4 fintechs with a license. My question is, you said you focus on risks. When these fintechs file a license, there's nothing to protect. There is no public deposits in there yet. There's no operation going on yet. So my question is, are you going to change your, basically your audit work and speed up? Because we have now fintechs waiting for a license since 2, 3, one in Geneva since 4 years. So my question is, do you see this as a problem? And would you like to help us to speed up? Because we have lost dozens of clients who went to Dubai, Lithuania, and at the current time we are at 4.
I think I got the question, thank you. And good to see you in person, and I have to sit straight, right? I read your LinkedIn posts when being on the panel. So of course the question you ask is relevant and legitimate. But there are some requirements in the law that need to be fulfilled to get a license by FINMA, right? And I think most of the people in the room, they know that and they have experience with that. And no asset manager, no bank, no fintech get licensed if they do not fulfill the requirements in the law. And maybe taking one step back, you talk about fintech license, so maybe not everybody here in the room is familiar with the so-called fintech license of Article 1B in the Banking Act. So it's basically a payment service provider license. It allows for accepting deposits from the public up to 100 million Swiss francs. These deposits are not, cannot be invested. You are not allowed to pay interest on these deposits. So what can you do? You can provide payment services, right? So this so-called fintech license fills the gap for a specific payment service provider license that we do not have in Switzerland. And now look at the market for payment services. In Switzerland, we have more than 300 banks, and everybody, I would say, we don't have, at least we can say we don't have a financial inclusion problem that can be different in other jurisdictions, right? But everybody who wants to do payments in Switzerland has access to payments. So if you enter the market as a new payment service provider, you should actually have a very good business plan and quite thought through which is the problem that I want to solve, right? Because if the only offer that you can make to the market is doing payment services, you have to find a niche that is not served well as of today. And there are definitely such niches, and we have some success stories among the fintech licenses. It's just a handful, you are right. Some of them are successful, some of them are not successful, but the ones that are successful actually prove that there are some niches and some inefficiencies that can be filled or addressed by new entrants, but it's quite difficult to find these niches. So it's not a huge market, it's a very competitive market. It's a market that basically follows the logic of high volumes and low margins, and that also makes it even more difficult in a small country and with a closed cross-border regime. So that's like where we are coming from, and that explains, I think, much more than the regulation itself why the number of fintech companies is small, right? It's just the macroeconomics and the business model that limits the market, and that will not change with the new regulation. With the new regulation, some things will be much better, but I don't expect like a huge growth of payment service providers in the future. And then, as I said, some of them are successful, some of them are not successful. We already had to close down 2 of all 7 that got a license. That's extremely resource and cost intensive. So. And that's a burden for the surviving ones, so we have to keep that in mind. And that leads us, of course, to checking the projects that are presented to us carefully. But I can say we license some companies that are not public yet, so maybe you don't have the full picture. There are some more licenses out there than it's publicly known. So it's definitely not the case that FINMA doesn't license any new market entrants.
Thank you very much. Yeah, I don't want to stretch it. I know that one fintech will just legally enforce their license this month, but I don't want to steal your time here and give others opportunity.
Thank you. Any other question from the audience? Also for the other panelists? Doesn't seem so. So I thank you very much for the participation. And then I will give the word to my colleague Emanuele for the next presentation.
Okay. Now I will speak about artificial intelligence in finance. I will cover briefly three main aspects: the regulatory framework, the most common use cases, and if AI could lead to systemic risks. First one is regulatory framework. So in Switzerland, we don't have a law for AI, but FINMA issued a circular with some expectation, and also for the auditors, that will ask you maybe the upcoming audits about these expectations for those financial institutions that uses AI to manage risk. And first of all, it's governance. The governance is important because you want to have an AI policy to allocate risks and responsibilities. Second one is the so-called shadow AI. I think it's one of the most concerning topics because most of companies do not know how many models are employed, how employees are using AI. And so the best way to address this is to draft an AI registry to map all your AI system within your organization. Then we have the data quality. If you provide, for example, services, well, if you use AI to, for example, financial projections, investment strategies, you want to have the best quality data in order to get a better output. So data that are unbiased, balanced, and so on. You want to test and monitor the AI system in order to detect any kind of performance drift, data leakage, and any kind of violation in terms of compliance. Documentation. Documentation doesn't, I mean, documentation is a very important point, not only to make FINMA and the auditor happy, but also because it can be very useful for you to defend you yourself in a litigation case before a trial, because you can demonstrate that you do the best that you can to minimize the risk and clearly to avoid it. Explainability. If you use agentic AI within financial markets, it's important to understand why and how the AI system has taken certain decision and possibly to correct if there are some issues or violation. And finally, independent review. The independent review can be done internally or externally. We as Lexify were more than able to help with that. For example, I am a lead auditor under one of the best standards for AI management systems, the ISO IEC 42001, so we can help you with that. Then we have what I say, it's the most common use cases. First of all, generative AI. I think most of you already know this for most general tasks such as policy drafting, customer support, compliance drafting, and so on. Then we have intermediate and more complex cases such as, again, for intermediate case, the use of an AI for building an AI strategy in terms of financial projections, investment strategies, and finally, where I would say the fun begins, so where you use agentic AI in the financial markets to place order, do market making, and Wall Street has been using this in high frequency trading for and for other stuff, but basically the use of agents in financial markets. I want to show you for the first use case for generative AI, one experiment made by the Bank of Italy a few years ago, where they instructed an AI, such as Claude, Gemini, and so on. They tested around 22 models. And basically, they made the AI impersonate a notorious manager of a financial firm that must face two choices. One is use the funds to cover the losses of the firm or go bankruptcy. So I think that the most logical thing is to use the fund to cover the losses. Problem was that the funds belongs to the clients. So that's clearly illegal and not ethical. And result, 99% of the model choose to use clients' fund instead of declare bankruptcy. Huge misalignment between the human behavior and the machine behavior. But what's more important is that to push even further the model, the Bank of Italy told the model, look, I have an upcoming audit on the financial performance of the company. And the model, in this case I think was ChatGPT, reinforced the behavior saying, okay, it's a financial performance, so I have to use the clients of the fund. So as you can see, huge misalignment. So the key objective of learning here is we have to maintain, as someone already told you before, the human in the loop mechanism. We cannot, for now, delegate decision to the AI because of these kind of results. And this, I think that you can, the only model that didn't misalign a lot was ChatGPT 01 preview. It was about a few years ago. Now we have much powerful models. So, and it's not only an experiment; it's a reality. We had 3 different use cases, not with AI. This is back to 2013 with simple algorithm, repricing algorithm in the markets. I have these 3 use cases. I want to present. The most interesting one is the second one, German petrol station. So basically, Germany issued an app where gas petrol station had to disclose the prices of the gas fee each day. Problem was that some of the operators adopted some algorithm to basically reprice and update the price daily by checking also and monitoring the market. And that was a problem because one of the algorithms start a war price in an oligopoly market, which is very bad in terms of, I mean, economically speaking, it's very bad. And without anyone noticing it, basically one of these algorithms triggered a vertical spiral upwards of the prices, surging the prices upwards by 7 cents per liter and margin 38%. Again, without anyone noticing it. And worst part is that the German authority could not sanction anyone because this kind of collusion wasn't really a collusion, legally speaking, because there weren't any kind of agreement, written or oral agreement. And so, again, the algorithm back then detected price signals and acted accordingly in a very anomalous way. And that's a very, I think, basic example on how you can, how something can go wrong with the repricing only algorithm. But with AI, we have the report of Deutsche Bank of last March 2026, where they actually proved scientifically that agentic AI can collude in OTC market. So they basically said when certain conditions are met, algorithms, especially agentic AI, can collude themselves, and they can basically manipulate the market. These are the 5 conditions. First one, unobservable prices, few players, similar algorithms. If the algorithm are basically built on the same logic, on the same mechanism, they can trigger a systemic risk when they actually have a huge volume, they do the same action, so they buy or they sell, and in certain segment of the market there is this risk of a systemic disruptive risk. Time, clearly in a very short period of time, and information parity is something that it's a problem, because clearly an algorithm is more knowledgeable than a human, and we cannot compete with that. So 3 key takeaways for you. Again, as I said, a human in the loop. We saw the case of the Bank of Italy. If probably the human was in the loop, we wouldn't have had this kind of case. Then inventory and testing for the gas petrol station. If someone had monitored the algorithm, probably we would have a different scenario. And third one, remember, when you employ an agentic AI in a specific segment of the market, be careful about the condition of the market itself. When we speak about high volumes, high frequency of operations, in very liquid market, we can trigger this kind of risk. I don't have any more points on my side. Thank you for your attention, and if you want to learn more about this topic, I will be available at the Apero. Thank you.
So we are now at the last presentation. It won't be long. I know that I am the one standing between you and our Apero Riche, so I will try to be as short as possible. Also because I have a topic which is not easy to digest, and that is CARF, the crypto asset reporting framework. So I know that many of you here are institutional, so we are here, there are banks, asset manager. You know what CRS is, so the automatic exchange of information. What we are presenting here very quickly is the automatic exchange of information for crypto assets, so for digital assets. Why that? Because you can imagine we have CRS, so we have a framework that allows us to assure that nobody can hide assets anymore. So it's very difficult to hide assets in the traditional finance, because all the account are, the information are given to the tax authority every year. You're collecting the information and you're sending it to the tax authority. But we have a parallel ecosystem, that is the crypto ecosystem, with self-custodial wallet, decentralized exchange, crypto ATM. So a lot of ways which allow user to avoid this automatic exchange of information. And in order to restore a level playing field, the OECD decided and put in place CARF. CARF is already applying in Europe. From 1st of January this year, the European entities are starting to collect the data, which will be exchanged next year. In Switzerland, we have a little bit more time, because implementing this CARF is not so easy. There are a lot of countries that are a little bit in delay, and Switzerland, they said, okay, if there are some countries that ask for a delay, let's do the same. We don't want always to be the first in class. And so we will start to collecting data on the 1st of January 2027. But I will tell you that's the only good news of this presentation. The rest, it's all things that you have to do. So when we apply the CARF, what we have to do, we have first to understand what are the assets, the digital assets that fall within CARF, because not everything is reportable. So we discussed before with the panel about CDBC, so central banks, digital currency, and e-money. So that's all tokens that are subject to CRS. Okay, even the digital euro, we heard it, it's something official. So that will be subject to CRS, not to CARF. And while there are also tokens which have not really a value, they're non-monetizable. So think at a real utility token, the token that you use for, I don't know, get any service. In reality, such tokens should not have a value, and therefore they're excluded for CARF. Included in CARF are all other crypto assets. So think about native token like Bitcoin, Ethereum, even monetizable NFTs. So assets that can really be used as a store of value or as an exchange or mean of exchange. There is a main distinction between CRS and CARF. CRS is based on accounts. I have an account, I have value in it, we do a snapshot, and we transfer the information about this snapshot. So the balance sheet, the yields that you receive, the dividend that you receive, practically your tax statement that you receive from the bank. By CARF is different. We have to transmit much more information. So CARF is transaction driven. We have, for every transaction that is done with digital assets, we have to collect the data and then transmit the data. So CARF, the trigger is a continuous. So every event trigger data that we have to transmit. So CARF, honestly, it's a little bit more, I would say much more complex than CRS for the collection of data. And here I make an example. So think about a transaction where we change some digital asset between them. So we have to collect information about, in fiat money, about the gross proceed of the asset that I'm selling and the acquisition value of the asset that I'm purchasing. And moreover, if I do a transaction, if I do a transaction above 50,000, I have also to collect information about this transaction. That's something that CRS doesn't have. So if I transfer money from my banking account to another banking account, CRS doesn't collect this information. With crypto, we will collect this information. By modifying the CARF, we modify also the CRS to make it compatible with the CARF. So let's say, for example, CDBC will be in scope within the CARF, within the CRS, and not the CARF. So there is an exchange in the rules for CRS, which will be applied in the Automatic Exchange of Information Act. And there are some, here the AI, because these slides are made by AI, of course, they define it as coordination nodes, so some point of contact between CARF and CRS where we can have some facilitation for example, those of you, and there are some of you in this room, that will have to apply CRF and CARF, but be aware that there are some mechanisms that allow you to make a little bit less of transmission of information because you don't have to send twice the same data. So the most important part, I think, is this one. So the outbound flow. So when I have a CASP, so a crypto asset service provider that is doing a transaction, and this is something that traditional banks, I know they are not doing so much now, but I expect that in the future I will have also the possibility to execute a transaction directly by my wallet that is in a bank or in another intermediary, and this intermediary has then to collect all this information and use it and give it to the tax authority. So a tax authority, that is also why when you do now a transaction from an exchange, thanks also to the travel rule, the exchange will ask you, where are you sending this money to? And they want to collect this in data, and this data is not only for anti-money laundering purposes, it's also for exchange of information. What as a financial intermediary to do? So you have to identify the clients also. So that is the next level. If you are a regulated entity, you have already identified the client. Okay, so you have already CRS, you have already the data of the client. So for you, it will be easier to solve this part. But if you are not subject to CRS right now, and you will be subject to CARF, then you have to collect all information about the clients, and that's not only AML information, but also tax-related information like the tax identification number. And new user, for example, so starting from the 1st of January 2027, you cannot accept new user if you don't have all this information. While for pre-existing user, you have to go to them and collect the information that you're missing. And you have time until you have 12 months of grace period to collect this information. So you should start now. And not only you have to collect information, you have also to make a reasonability test. So the information that you're receiving are correct? Are they in line with the one that you already have? Or there are some suspicions that the person are not giving you the right information? In this case, like it is the case for AML, you have to make a remediation and start to collect the correct information. So at the end, you see what is the infrastructure if you want to be compliant with the CARF. First layer, you need to have a system to transfer the information to the tax authority. Don't think that this is something that you can do manually. That's too complicated. Even if you are a small financial intermediary that just make a bunch of transactions, you should automatize this process. Then compliance integration. So we need to collect the data about the transaction. So we have to rely on the travel rule to know where, in case of transaction, where is this money was sent to. Then pricing engine, because as I said before, if we do an exchange, we have to collect the information about this exchange and send the information to the tax authority. So we need a good pricing engine. And finally, the onboarding, we need to know who is the clients and all the information about these clients. So you see, CARF is something quite complex, but I will say quite complete. So with this implementation, I think the tax authority will be very pleased. And with this, I also thank you for hearing my presentation, and I leave the word to my colleague Sarah for the conclusion.
Thank you, Lars. Well, we have come to the end of this third edition of the Finance Evolution Forum. Before we close, allow me to make it official. After Dubai, Lexify is proud to announce, Okay, maybe better. Before we close, allow me to make it official. After Dubai, Lexify is proud to announce the opening of the new office in Zurich. Once again, thank you. Once again, I would like to thank you, our speaker, our guest, our sponsor, but the most important thank you goes to you for being part of this event. On behalf of the Lexify team, I wish you a pleasant evening, and we invite you to join us for the business networking and standing dinner. Thank you again, and see you next year.